Good morning. I'm Warren Dueck, and I'm here with my colleague, Leena Sameen. Good morning, Leena.
Good morning, Warren.
And we're going to talk about the renunciation of U.S. citizenship, Tax 101. So this is going to be an interesting session. There's lots of material to cover. We're going to focus on the tax aspects of renunciation. And, you're welcome to ask questions. And you can submit those through Zoom. We'll have some time at the end of the session. We'll do that. We're also going to have some polling questions. And those polling questions will be used in the future that you can actually get credit for continuing professional education and continuing professional development. So you'll see some polling questions there, and those are kind of interesting too. There's a survey at the end too. After you've signed off, we'll send you a survey. Please let us know how we did. We're interested in your feedback. And if you'd like closed caption, there is a live transcript you can actually get through Zoom. So our agenda today, we're going to talk about renunciation of U.S. citizenship, who is a covered expatriate, U.S. exit tax, and then some forms and stuff like that. One of the questions I just want to address is saying is, why would someone renounce their U.S. citizenship? I mean, citizenship is a valuable, and we'll call it an asset. It's valuable to people, and various forms of citizenship have value, and oftentimes U.S. citizenship has been looked at as extraordinarily valuable. So why would you want to renounce that? Remember, I already told you we're tax people here, so we're going to talk about the tax implications. And what we know about U.S. citizenship is there's a cost to it. That cost takes the form of taxes, in that as long as you're a U.S. citizen, you're taxed on your worldwide income, regardless of where you live in the world. So now, in most cases, U.S. citizens living in Canada, for example, won't pay U.S. tax. Now, they can pay some. There's a lot of circumstances that they can rise in tax, but that doesn't necessarily happen. But they are exposed to penalties. And most of all, they're going to write a check every year if they have someone prepare their U.S. tax return for them. And oftentimes people do that simply because the penalties are so high associated with failure to make certain disclosures and things like that. So U.S. citizenship can be costly. So the thing I encourage people to think of it as saying is, there's a cost to it. Does the value of being a U.S. citizen offset it? If you plan to live in the U.S. in the future, well, then I'd say that's probably true. If you never plan to return to the U.S., it might not be worth as much to you. So, there's all sorts of reasons why people might renounce their U.S. citizenship: politics, presidents, whatever you want to make it do. But there's a tax implication here, and it's expensive. And candidly, people living outside the United States don't have a lot of input in terms of changes in tax law. There are a lot of U.S. citizens living outside the U.S. They all can vote. It's really hard for them to actually make an impact politically. So we're going to talk about renunciation, and I'm going to pass over my colleague, Leena, who's going to talk about renouncing U.S. citizenship.
Thank you, Warren, and for explaining some of the reason why a person may decide to renounce their U.S. citizenship, because as you indicated, it's a critical decision and it can have permanent consequences and also significant impact on a person's current and future financial circumstances. So now let's just say if a person has talked to their immigration attorney and also they have talked with their tax advisor and they have decided that they want to renounce their U.S. citizenship, there are a few steps that they need to follow. The first thing is that when they are renouncing their U.S. citizenship, they can be inside the United States. So they have to be outside of the United States. So that means either they are in Canada or in another country to renounce their U.S. citizenship. In Canada, they can obtain an appointment in the nearest U.S. embassy or consulate by email. So the appointments can be made by email. But it's important to note that the waiting period is pretty long. So it could be months and months of waiting time. So it's important to make that appointment as early as possible to make sure that the timing is right. And Warren and I will be discussing that throughout the presentation as to why it's important that the timing is right.
Now, Leena, people could go, as you noted, to other countries as well. You don't have to renounce in Canada.
Correct.
So
yes.
I think Canada and Mexico may be the only two countries where you have to actually make an appointment. But if you look at countries to the east and west of Canada, I think you're stuck with, I shouldn't say stuck, but Japan and Iceland. And so you could actually make this into an enjoyable trip if you decided to do that.
That's true. So once the appointment is made, the individual will have to complete the necessary forms that we will be discussing throughout our webinar, what those forms are. So those forms has to be completed accurately. And there is a hefty fee of $2,350 that need to be paid at the time of the appointment. So once the appointment is made, the individual will have to appear in person, and it's important to note that they have to go alone. So they cannot bring family members, spouses, friends to that appointment, as they want to make sure that the individual is making that decision voluntarily without any force.
Now, Leena, they can actually bring people with them. They just can't go.
They can't
into
take them to the
appointment.
interview. Right.
Yeah. So you got to go in on your own. And like I said, they've got to determine whether or not they're doing this voluntarily. And if they have someone walking behind them with an object pointed in their back, that's probably not a voluntary renunciation.
That's true. So the person who is intending to renounce their U.S. citizenship should be aware that they should have a second form of citizenship. Although it's not a law that the person cannot be stateless, but it's important that they have some kind of citizenship, like let's say in Canada or anywhere else in the world, to just make sure that they are able to travel, they are able to work, or also get medical benefits and other stuff that they will need for day-to-day life. So it's important that another form of citizenship is in place before renouncing your U.S. citizenship.
Now, I think it's an interesting point about citizenship, because Canada, for example, if you become a Canadian citizen, there are no tax ramifications of becoming a citizen of Canada. In other words, Canada doesn't seek to tax its citizens when they live outside of Canada. The U.S. is the only developed country in the world that actually does that. Mm-hmm. So Canadian citizenship doesn't impose a cost on people, unlike the U.S.
That's true. So once the application is approved, the individual must sign the oath of renunciation, which is basically a prerequisite for the renunciation. And after that, the individual will receive a certificate of renunciation, which is basically a proof that the person has renounced their U.S. citizenship. Now, again, we will emphasize that this is an irrevocable decision. So although a person can in the future, if they want to decide to become a U.S. Person again or U.S. citizen, they can, but they have to go back to the end of the line. So they would have to go through the whole process of becoming a U.S. citizen all over again. And that could be a lengthy process. That
would mean actually getting a green card, living in the U.S.,
right,
and then ultimately applying for citizenship again.
Yeah.
But I think people should really view it that this renouncing your U.S. citizenship is a final act.
That's right.
It's not impossible, but it would not be a very easy thing to do.
That's correct. So moving on to the next, I think, Warren, you have the...
Well, I'll just make a few other comments here. I think that one is when you renounce, it's effective the date of renunciation. In other words, if you go to the embassy or the consulate on June 3rd and renounce your U.S. citizenship, it's effective June 3rd. Mm-hmm. And Leena mentioned about what's called the Certificate of Lost Nationality will be issued about 6 months later generally, but it'll be effective June 3rd, not the date you received the notice from the Department of State. And we encourage people that renounce their U.S. citizenship actually retain a copy of that Certificate of Lost Nationality in their passport. Because when they enter the U.S. and it shows that they were born in, Brooklyn, New York, or Wenatchee, Washington, or whatever, they can show that they've actually gone through the process associated with it. A couple other things I want to address too. One is something called the Reed Amendment. If you renounce your U.S. citizenship to avoid U.S. tax, at least in theory, you can be barred entry from the United States. Now, that's the way the law reads under the Reed Amendment. The U.S. State Department has told its embassies around the world not to seek to enforce that provision. The belief is that it's unconstitutional, that a U.S. citizen should be allowed to renounce their U.S. citizenship without adverse effects. And to my knowledge, there's never actually been a court case involving this. So this has been around for a while, but it's kind of a benign sort of thing. What I encourage people to do is when they renounce, tax is not one of the reasons. We talked about it earlier, that that may be how you feel. You may like the president or not like the president or not like the politics, whatever the case might be. I would focus when you renounce on just the intention of saying, hey, I've lived in Canada for 20 years or 50 years, whatever that time period is, and I want to be a citizen of Canada only. That's how I see myself. You don't have to prove yourself in that respect, but don't introduce other elements to it. The other thing I'll mention too is green cards. This is about U.S. citizenship, but long-term green card holders go through a very similar process, not so much in the renunciation, but in the fact the tax implications that come from it. And we'll talk about this a little bit as we go along in bouncing into that. So I'll leave that for future sessions. And we'll flip to the next slide here. Who is a covered expatriate? Well, anything that has a special name in tax law is a bad sign, right? It's like anytime there's a special name, it's never because of something good. So the importance of covered expatriate is someone who is a U.S. citizen that renounces their U.S. citizenship, or as you can see on the slide, or abandons their green card and are a long-term resident of the U.S. Long-term resident is a defined term. It means someone who has held a green card in more than 7 calendar years. So, just a word of caution here. I advise people, if they can avoid getting a green card, avoid getting one as long as possible, because as long as they have a green card, as soon as they get a green card, a clock starts ticking. And then they're subject to the potentially same provisions here. So someone who's either renounced their citizenship or abandons a green card and are long-term resident could be a covered expatriate if they meet one of the following tests. And those tests you can see here, there's 3 of them. Their average annual U.S. tax exceeds $190,000 for 5 years. Now, I don't want to say this is impossible. That's not true. But people who have resided in Canada for the last 5 years, even though they may be quite wealthy and have a very high income, it's generally unlikely that they'd have $190,000 of tax. It's not impossible. And that's because this tax is after they've paid their Canadian tax. So let's say someone who makes $1 million a year in income and they paid $250,000 of tax in total. Less than $190,000 would be taxable in the U.S. would result in a U.S. tax because of the way foreign tax credits plays here. So, well, you need to be concerned about this. Doesn't necessarily apply for people in long term in Canada unless they've had some unusual events here, and there's some solutions there too. Those solutions. Just to note here, if you file a joint return, let's say there's a husband and wife, and the wife is making all the money, but the husband files jointly with the wife. The test here is if you've been part of a joint tax return, that $190,000 applies even though it's all the wife's income. So just be careful, joint tax returns. You can avoid this by filing separate tax returns for a few years and getting your average tax down. So there are solutions there. Number 2, if your net worth exceeds $2 million, you'd be subject to this. And that net worth includes all your worldwide assets. That includes your RSP, your tax-free saving account, your principal residence in Canada, your investment securities that you have, all your worldwide assets, includes your pension. You say, well, that's not an asset. I get income from. Well, it's an asset for this purpose. So if you're at your expected lifespan, there's actually actuarial tables you'd use to determine what the value of your pension is. If you get $20,000 a year from your pension, and your expected lifespan is 20 years, that pension might be worth $400,000. So there's a computation there. The last one is if they fail to certify they've filed 5 years of complete U.S. federal tax returns. Now, this happens a lot where U.S. citizens living in Canada and other parts of the world too haven't been current in their U.S. tax returns. There's a relatively easy process, or I'm going to say painless process to do this that avoids all penalties, and you can file up to 5 years of returns. It's something called streamlined. So if you meet either one or two, you're subject to U.S. exit tax. Did you have any comments, Leena, on those?
I do. So Warren, when we say the net worth of $2 million, so let's say if I'm like most people who are living in Vancouver, let's say if they have a house that's worth $3 million, but they have a mortgage of $1.5 million on it. So they probably will not meet that test, assuming that's their only asset.
That's right. It's net worth, and you subtract liabilities from that. That's exactly right.
Yeah.
Yeah. Now you have to be careful if you have a $3 million home and you decide to borrow, as Leena suggests, $1.5 million, but you put that $1.5 million in stock market. Now you still have a net worth of $3 million, and your total assets are $4.5 million, and you've got a mortgage of 1.5. So there's some work here. There's some opportunities here. There's a bunch of different ways you can deal with all three of these thresholds. One of the common ones for net worth issues, which are really significant ones in places like Vancouver or Toronto with high housing prices, is gifting. And gifting can be a very effective tool here. It has some limitations, but gifting can solve a lot of problems for people. So there are solutions here. Leena, you're going to tell us about some exceptions.
That's right. So Warren, you mentioned that it's not a good thing to be a covered expatriate. So if we can avoid it at all, it's a good thing. So there are two exceptions to the exit tax for U.S. citizens who are looking to renounce and not be a covered expatriate. The first exception is limited to dual citizens at birth. So that basically means if a person was born with two dual citizenship. So if they were, let's say, a citizen of the United States and Canada. Now, there are other requirements to for this exception, that the person at the time of renunciation has to be living in their other nationality country. So for instance, like if a person is a citizen of the United States and Canada by birth, but now they're living in Germany, so they cannot renounce their citizenship from Germany. So they have to become a tax resident in Canada at the time when they are renouncing their U.S. citizenship.
Now, Leena, did I understand that correctly? If they're German and U.S. or they're German and Canadian? If
they're U.S. and Canadian.
Okay. Yeah, they have to reside in their country of their other citizenship at the time they renounce. They don't have to stay there.
No.
But they only have to be resident there when they actually renounce. So, like, say, if they were living in Germany, they could come back to Canada for, a period long enough to establish residency, and that's a broader topic. But renounce, and then they could return to Germany.
That's right. So it has to, we have to do their tax planning, and they need to talk to their tax advisor to make sure that they are not subject to being a covered expatriate. The second exception applies to individuals who renounce their U.S. citizenship before the age of 18 and a half. Now, this one is a little bit tricky because, as we mentioned, the appointment times and getting the appointment in and even planning to renounce the U.S. citizenship could take time. So the window might be short for individual to decide if they want to renounce before they're 18 and a half, because the interview process for individuals who are less than 18 might be lengthier, and at some point they probably need their parents' consent. But as we told you guys earlier, that they have to make that decision by themselves. So a parent cannot make a decision for their kids or vice versa. So it's important that the individual consult with their immigration lawyer as well as with their tax advisor. Now, I want to mention that these individuals are not subject to net worth test and also the annual tax, U.S. tax limit, but they are still subject to the compliance test. So they still have to have the 5 years of complete filing for U.S. purposes before renouncing their U.S. citizenship.
You'll have to forgive my tax humor here, audience, and Leena too, but I call these exceptions the get out of jail free cards.
Yes.
And particularly the dual citizen at birth. And many of the people we deal with are U.S. citizens resident in Canada. They may have never lived in the U.S. Or lived in the U.S. for just a short period of time. But if they're a dual citizen at birth, all they have to do is certify they've filed the last 5 years of complete U.S. tax returns. And if they haven't filed U.S. tax returns, that's a solvable problem, as I said before. And but that net worth test, they could be worth $1 billion, and they wouldn't be subject to being a covered expatriate. They could have a very high U.S. tax liability, and they would still not be subject to the U.S. exit tax, which we're going to talk about in a few moments here. So these are great exceptions, and oftentimes not understood or overlooked.
And probably Warren, you would agree that the compliance test is probably the easiest to solve.
Oh yeah, that's that's absolutely the easiest to solve, unless the people have willfully avoided filing. And again, that's a broader subject here. That's going to be quite unusual. It's a pretty broad or pretty narrow thing to willfully avoid filing U.S. tax return.
Okay.
Ready
so
to go to the
now-
polling question?
Yes. So this is
Okay.
the exciting part of our webinar today. So we have polling question, as Warren indicated in the beginning, and these questions will appear on your screen for 45 seconds, in which you will need to answer, and then we will announce the correct answer. So the first question we have is, who is a covered expatriate? An individual, A, who is a U.S. citizen, B, whose net worth is less than 2 million, or C, whose average annual U.S. tax is more than $190,000.
Boy, this is kind of a test of our skills as leaders here. Did people get these questions?
And we didn't want to be tricky. So. Okay, so I
The results
think we
are
have,
in.
oh, and we have the right answer. The majority of people answered the correct answer, which is whose average annual U.S. tax is more than $190,000. So A is incorrect, because once you are a covered expatriate, you're no longer a U.S. citizen. B,
You've already renounced.
You've already renounced.
Yeah.
And then B is incorrect because, Warren, as you indicated, that the net worth test is more than $2 million. And obviously C is the correct answer.
Just on C, it says whose average and U.S. tax is more than 190,000.
Right.
That test is over a 5-year period, the most recent 5 years. So, you know, that number, like say, goes up and down, and there's solutions to avoid that if you're a high income person that has a high level of U.S. tax. This is usually the problem for people resident in Canada. Their challenge is that their net worth exceeds $2 million.
That's right.
So we said people that are covered expatriates a bad thing. The question then is, why is it a bad thing? Well, we're going to talk about 3 of these issues that come up as a part of U.S. exit tax. We'll refer briefly to the other 2. But for U.S. exit tax, 5 things can happen. We're going to talk about 3 of them. One is there's a deemed sale of your worldwide assets. These are not just U.S. assets. These are worldwide assets. They could be Canadian, they can be Brazilian, they could be French. I don't care where in the world they are. You'd be deemed to dispose of them and subject to a tax on the gain. Now, the good news here is there's an exemption of $821,000. And so if your gain was less than $821,000, and this is indexed to inflation, then you wouldn't have any tax to pay on the deemed daily worldwide assets. It doesn't mean you wouldn't have other implications from U.S. exit tax, but that wouldn't apply. There'd be a cap. The capital gain rate, the tax rate goes up to 20%. There's no exemptions or deferrals. So things like sale of a principal residence, other deferrals do not apply for the purpose of this test. Also, there's a special rule for green card holders. We said this would perk up here. And I'll also note too, a lot of people say, oh, I used to have a green card, but it expired. Now, green card is the colloquial term. It's not actually the right term. The correct term for green card is lawful permanent residence. And unless someone formally abandons a green card or it's judicially rescinded, and in either case, they should receive an I-407 from U.S. immigration authorities, they are still a U.S. resident for U.S. federal income tax purposes. Now, there is a special rule for green card holders that says that, you know, if they acquired their shares of Microsoft when they were 3 years old, moved to the U.S., let's say their shares of Microsoft when they were worth $3, and they moved to the U.S. and now these shares are worth $3 million, and they acquired a green card at that time, their tax basis would not be $3, it would be $3 million. So they can elect to increase their tax basis to the fair market value at the date they became a green card holder. Any questions or comments on that, Leena?
No, I think you covered everything.
Okay, this is yours.
This is also an interesting topic because the deferred compensation. So the deferred compensation is deemed distributed when a person renounces their U.S. citizenship, assuming they are a covered expatriate. So this deferred compensation includes retirement and pension plans. It could be both U.S. or foreign. And what does deferred compensation means? Deferred compensation basically refers to any compensation that comes to you from performing services. Now, that doesn't mean that it has to be paid right away. It could be paid at a future time. So if an individual is considered a covered expatriate, they will be subject to tax on their deferred compensation. So for instance, if a person is receiving $50,000 a year from their plan, but now as a covered expatriate, they will be subject to tax on the value of the plan.
So if they got $50,000 a year,
Mm-hmm.
and let's say, you know, that plan was worth $1 million, are they paying tax on the $50,000 or the $1 million?
$1 million.
$1 million, yeah.
Yeah, so that's where it's like deemed distributed at the time of renunciation. So it means that they would have received that when they renounced their citizenship.
So just back to that, if I can interrupt, Leena,
sure.
Which I'm doing anyways, aren't I? On that $1 million, they receive $50,000 a year, but the pension is worth $1 million over a lifespan. But now they have to pay a 30% tax. They have to pay $300,000 today, or when they renounce their U.S. citizenship. Actually, it's in the tax return for that year.
Right.
And they only get 50. So they're cash out of pocket here.
That's right, because they haven't received the distribution yet, but they are deemed to have received that. Now, right. There is tax treaty relief may apply, but we would need to look into that one. So exception to this rule is if you receive eligible deferred compensation, which will be taxed when it's paid. So what makes it an eligible deferred compensation? To make it an eligible deferred compensation, the individual who is renouncing has to make an election, and the payer must be either a U.S. payer or the foreign payer has to make an election to be taxed as a U.S. payer. Now, Warren, I want to hear your thoughts on this. Would a payer elect to be paid as a U.S. person, as a U.S. payer?
Well, you know, it's only for this purpose.
Correct.
It's not a broader thing. So if you're, you know, let's say you're getting your pension from Air Canada. Here's my bet, if we have any airline pilots sitting in the group here. that Air Canada is going to be at best reluctant to do this. Now, remember, in my example, we said you're going to owe $300,000, even though you're only getting paid $50,000 a year. I'm not saying you're getting $50,000 as a pilot with Air Canada, but so Air Canada would have to file this form saying we're going to elect to do it. And basically what it does is it forces them to withhold the tax on payment. That's really the requirement. My observation is this: most companies will reject doing this. There's nothing that forces them to do it. Smaller companies will be more likely to do it because they'll realize the hardship they're putting their former employee on. And as long as they have some confidence that it doesn't obligate them to do something more, they're probably more willing to do it. So this is a tough nut here for people who receive pensions and retirement plans from outside the U.S.
Right. And even when they make that election to be considered an eligible deferred compensation, the value of the plan would still be considered for the net worth test. So let's say if the value of the plan is $500,000, now they made an election to be taxed only on the distribution that they actually received. That doesn't mean that the $500,000 value would not be counted towards the net worth test.
That's right. Yeah. We talk about bad news number 3.
Sure.
Okay, bad news number 3. U.S. exit tax, a tax on a covered gift or bequest. Now, this sounds so benign here, talking about a covered gift or bequest. What this really is doing is imposing U.S. estate and gift tax on people who have renounced their U.S. citizenship if they make a gift or a bequest. A gift is made during your lifetime. A bequest is made through your estate. If it's made to a U.S. person, that includes a U.S. resident or a U.S. citizen. And what's unusual here is gift tax and estate tax are usually on the person making the gift or in the state that makes the bequest. But in this case, it's the recipient is liable for the tax. And it's a 40% tax. It applies to both direct and indirect gifts. In other words, if you make it to a trust with a U.S. person as a beneficiary, it would apply to them as well. This is probably, a lot of people are comfortable with the first 2 items we talked about. They say, I don't have any deferred compensation, or maybe it's a small number. Or they might say, well, I've got substantial assets, but there's not substantial gains associated with those assets. So they're not worried about the first 2. But the tax on covered gifts or bequests is going to impose U.S. estate tax and gift tax effectively on people who are no longer U.S. citizens, where they make gifts to U.S. persons. Now, in my experience, the common scenario here that I've seen this is people have become, they've moved down to the U.S., they've worked in the U.S. for a number of years, their children are all born there, and now their children are all U.S. citizens. The whole family moves back to Canada, but the children are still U.S. citizens. So either the children also renounce their U.S. citizenship, and there's a difference between someone who's in their 50s or 60s renounced their U.S. citizenship because they said, I've decided I'm going to live the rest of my life in Canada, and your child who's 20 or 30 and maybe wanting to go to the U.S. to work or uncertain about their careers, having them renounce their U.S. citizenship is maybe more problematic. So this part of U.S. exit tax is really problematic for people. Did you have any comments or questions on that, Leena?
No, the only comments I would have is that when, let's just say, if a person decides to move out of the United States and their net worth is, let's say, $10 million, but now they move from United States to Canada and their net worth is $30 million. So that $30 million, if they decide to give it to their U.S. kids, would be subject to this 40% tax. Is that right?
That's right. Yeah. Remember the tax is based on the value of the gift.
Mm-hmm.
Unlike Canada, which when you make a gift, it can create an income tax liability. It's a capital gains liability. it's in Canada, it's on the appreciation. In the U.S., it's on the value of the gift. So if you gift cash, there's no gain associated with that for Canadian tax purpose. But if you gift cash for U.S. purpose, it's a value of the cash that you gave. So that can really be substantial here, and it's a real problem. So this is one of the bigger issues, is this part. And, the goal, as Leena said here, is to avoid being a covered expatriate, because if you're not a covered expatriate, U.S. exit tax does not apply. And that's generally where you want to be. Now, there can be circumstances where you want to plan yourself into that. But before we go into that more, what I'd like to talk about is there's two other forms of U.S. exit tax. We didn't include them here. They're more specific. One is on something called specified tax deferred accounts. Those are things like individual retirement accounts in the U.S. would be an example of that. RSPs are not in that category there because they're not a U.S. account. The other thing is on non-grantor trusts. Now, U.S. tax law splits trusts into two basic categories: grantor trusts and non-grantor trusts. And grantor trusts are treated as the person who made the transfer to the trust still owns the asset. So those are just treated as though they still own it. But non-grantor trusts often are two irrevocable trusts. The person who makes the gift can't get it back. Non-grantor trusts, if they have U.S. beneficiaries, and you're a U.S. beneficiary and you renounce your U.S. citizenship, or you're a long-term resident, you're a green card holder, you would be subject to U.S. exit tax on that. So, that's a problem. We ready for polling question number 2?
Yes, we are.
Okay, let's go.
Okay, so polling question number 2, and again, same rules apply, 45 seconds to answer. So the second question we have is, which assets are subject to U.S. exit tax? A, only assets located within the United States. B, only assets located outside of the United States. C, all assets regardless of location. Or D, none of the above.
Again, like we said before, this is really a test on us here. Like, did we explain stuff on it? So we're really hoping you all get this right. There is no penalty for getting it wrong, by the way.
No. So we should be getting the polling results any second. And they are in. So we have 94% people answering the correct answer, which is all assets regardless of location. So as Warren indicated, that on renunciation, there's a deemed sale of worldwide asset, regardless of where they're located. They could be located in Canada. They could be located anywhere in the world. There will be a deemed sale of those assets. So location doesn't matter. As a U.S. person, you just have to pay tax on your worldwide assets and your income.
And as we said before, I mean, these are things like as Canadians, we think, oh, my principal residence is not subject to tax.
No.
Well, it's true. It's not subject to Canadian tax, but it might be subject to U.S. exit tax.
That's right.
If you're a covered expatriate. And, RSPs, registered accounts in Canada, tax-free savings account, registered education savings, all those things would be subject to U.S. exit tax. So all assets, regardless of location. We did much better on that one, but we still had a few people either failing or unintentionally failing just to get us. So we'll see if we do better by the time we get to the third one here.
Yes.
So here's some things to watch out for. Community versus separate property. There are a number of states, mostly in the Western U.S., that have community property rules. Community property is a really interesting concept because when those people, and for example, Washington is a community property state, California is a community property state, Arizona, I think Wisconsin is, there's a handful of other states too, but they're community property states. So, for example, I worked in Seattle for a number of years, and when I got a check that said $100, Warren Dueck, that $100 was not actually all mine. Because it's community property state, that income was earned equally by my spouse. It only had my name on that, but it was still, half of it was hers. And in any sort of dispute over the ownership of property, you know, she gets half of that. That was half was hers, including half the assets that were acquired with that income. So in community property states, we'll have someone say, "Oh no, you know, I only own, you know, I've got a individual retirement account and maybe a few other assets. My spouse owns the home, and he's got our $10 million stock portfolio." Well, if that stock portfolio was acquired when you lived in California or Washington, both community property states, each spouse owns it equally, even if it's only the other person's name on the account. So there's a tax planning opportunity this way too, especially for U.S. people that move to Canada, is because in Canada, we go bananas over splitting income between spouses, because where one spouse is working at a higher wage and another spouse is working at a lower wage or not at all, we want to transfer income to that lower income spouse. That happens naturally in the U.S. under the community property rules. It also happens in the U.S. because of joint tax returns, neither of which do we have here in Canada. So community property only exists in Canada after the dissolution or death of a spouse, dissolution of a marriage. So watch out for that if you've come from a community property state or you're living in a community property state and intend to move. It's a good news, bad news scenario. So there's both there. You need to figure out how you're going to deal with both. Gifting limits for a non-citizen spouse. U.S. tax law is very specific here. It says that you can give an unlimited amount of money and property to a U.S. citizen spouse. And why is that? Well, it's because that U.S. citizen spouse is always going to be subject to U.S. tax on that asset and always subject to U.S. estate and gift tax on those assets. But if that spouse is not a U.S. citizen and they cease being a U.S. domicile or resident, then U.S. gift tax and estate tax gets eliminated. So there's a limit, and the current limit is what's the current limit? 178,000,
something like that. Yes.
Yeah, it's about 170,000. I think it's 178,000 for 2023, and that changes every year. It gets stepped up by inflation. Double tax. This is a problem. Any U.S. citizen resident in Canada always has a double tax issue, and that hopefully gets eliminated when you have your returns properly prepared. But what you want to do in Canada to avoid double tax, if you're going to pay Canadian tax on it in this year, you always want to pay U.S. tax at the same time, and vice versa. Because if you pay Canadian tax this year and then pay U.S. tax several years later, you don't get to use necessarily your Canadian tax to offset your U.S. tax, or vice versa. Pay U.S. tax this year and pay Canadian tax later. The goal here is to match those tax so you can claim those foreign tax credits. Now, I've simplified my example here, so it's a little more complex than that, but you're always trying to match income in both countries. Foreign exchange, U.S. always taxes your historical gain, and that's historical gain at historical exchange rates. So you'd be making a mistake if you said, well, I've got a $100,000 gain in Canada, therefore my U.S. gain must be the current exchange rate times that $100,000, and I've got a gain of $76,000. You may have a loss for U.S. tax purposes, or you could have a gain in the U.S. that's several $100,000, simply because changing exchange rates. It wasn't that long ago, about 2010, where, if I remember correctly, the Canadian dollar was, $1 Canadian was $1.10 U.S. And we probably, as Canadians, know more that the exchange rates have been against the Canadian dollar more recently. So be careful foreign exchange issues. Long-term resident. So if you get over that 7-year threshold, I use 7 years because once you get to 8 years, and if you receive your green card on December 31st of 2023, that's 1 year, even though you only held it for 1 day in that year. So if you're over 7 years, you become a long-term resident. As I said before, I encourage people to avoid getting a green card as long as possible. If you can qualify yourself under some other provision to be in the U.S., I'm a tax guy, so I could say this. Even if it was to be legally present in the U.S., I'm not promoting that subject. This test does not apply to you. It only applies once you get a green card. Mm-hmm. And then what your goal has to be at that point in time is if you decide you want to come back to Canada, you've got to come back before you get past that 7-year mark. Because once you get to that 8th year, you're back in this U.S. exit tax. Now, I'll let you decide if that's good news or bad news. Obviously, there's lots of issues here. So
there's a lot of problems with the renouncing citizenship, but Warren, as you indicated, there's a lot of solution also available. So with right tax planning, a lot of these issues can be resolved before a person decides to renounce their U.S. citizenship.
That's right. Yeah, this is all about just planning ahead, being aware of it. I got a call from a client of ours who I said, when he went down to the U.S., said, I want you to remember, before you get a green card, give me a call. So he actually called me up last week and he said, I'm thinking about getting a green card. I said, are you sure you can't get status any other way? Well, I said, but a green card seems like such a good thing, doesn't it? I said, well, yeah, sure, I get that part. But for tax purposes, that clock starts ticking. So, you never want to have a clock ticking on you because that means you're going to run out of time. If at the end of, when you get past 7 years, you say, I want to live in the U.S. for the rest of my life, that's great. I'm not trying to get you out of the U.S. I'm just saying there's some tax implications that run from that. So we've talked lots about concepts and stuff like that. I'm going to flip to this slide, which is full of information. And, being accountants, our life is full of forms. One of the big forms here, if you renounce your U.S. citizenship or you abandon your green card, is something called IRS Form 8854. It's an expatriation statement. It's called Initial and Annual Expatriation Statement. The annual part is really something that's almost disappeared from the screen. It would apply if you had renounced before, I think it's March of 2010. Everybody has to file who renounces or abandons their green card, but only covered expatriates actually end up with a tax. The other people just have a disclosure obligation. People can elect to defer their tax. This is an important thing to be aware of. Deferral sounds great because Canada allows you to defer your departure tax interest-free, but the U.S. does not. It allows you to defer the tax, but it's subject to an interest charge. And that discourages most people from deferring the tax because you can end up with a really substantial liability. And this form is generally due with your final U.S. tax return. So if you renounce your citizenship May 31st of 2023, in your 2023 U.S. tax return, it would be included with that return due in 2024. Now, Leena mentioned some forms you need to do for renunciation. These are them there. You can find them on the internet. There's 3 of them. They're pretty basic forms. Sometimes I get asked by people, do I need to speak to an immigration lawyer? Well, there's no requirement to speak to an immigration lawyer. There is no requirement to speak to a tax person either. But my advice, at least on the tax side, is saying, there's a bunch of things in here you want to make sure you get it right, because getting it wrong could be a very expensive process. And from an immigration standpoint, same thing here. You know, do you understand all the implications associated with it? And, you know, we're not trying to promote renunciation of U.S. citizenship. We want to make you aware and give you information you can use to make good decisions with. But, you know, ultimately, you have to decide on those things. And it can be helpful to speak to a tax and immigration advisor to make sure you understand how these things work. So we've got polling question number 3.
And last question, how are a formal U.S. citizen taxed in U.S.? A, the same as other residents of Canada. B, only on income arising in U.S. C, worldwide income. Or D, only A and B.
Hey, this is kind of, we didn't really prep people on this question. So you have to kind of be reading between the lines here on this one a little bit. We've kind of given you information, but we didn't give you all the information here. So this will be interesting here. I think we're going to be under 94% on this one. And the envelope is...
Ooh, we got all kinds of answers.
Yeah.
So the correct answer is D, only A and B. So this is a little bit tricky question, but we tried not to make it tricky. So you would be taxed same as, once you renounce your U.S. citizenship, you would be taxed same as other residents of Canada, and be also only on income arising in U.S. So that would basically mean if you have a rental property in the United States, that rental income would be still subject to U.S. tax. Or if you sold a rental property or a property, real property in the United States, that income would be still subject to tax, same as for any other Canadian resident, the taxation would apply. So no longer subject to worldwide income tax on your income.
So you said we tried not to be tricky. I think this is actually still pretty tricky, Leena. And I just want to explain here, we said A says the same as other residents of Canada. Well, are other residents of Canada subject to U.S. tax? Only in the case of B is where they have income arising in the U.S. And, you know, as you mentioned, that could be dividends from the U.S., be subject to dividend withholding tax. In the U.S., you get dividends from General Motors, for example. 15% of that dividend should be withheld under the treaty. There are some things you can do to get that rate. You know, if you had, if you worked in the U.S. for a U.S. employer, you'd be subject to tax on that. But the key aspect that you actually worked in the U.S., in other words, working in Canada for a U.S. employer does not subject you to U.S. tax. Especially in today's remote working environment, we see lots of that where people are working for U.S. employers in Canada. If you're not a U.S. citizen or you've renounced your U.S. citizenship, there's no U.S. tax because you're protected under the terms of the treaty, and that often gets missed in those cases. So that's the end of our presentation. We have time for some questions. So I know we had some questions submitted before this. Thank you for joining us here. We'll go on for about another 10 minutes or so, as long as we have questions. Or we might not answer all the questions here, but till we get till the top of the hour. Once you sign off, you'll get a copy of our survey. And please let us know how we did. And if you have interest in other topics you'd like us to cover, we'd love to hear that. And we'll stay for questions. Thank you for attending. We appreciate your support in these things. We get a great crowd, and it's good to be with you. And I wish I could see your faces, but I can't. You can see mine. So, Stan, you've got some questions for Leena and I. What are your questions?
Yes, Leena, thank you for the presentation today. We got quite a lot of questions, and a lot of them are related to this green card holder, actually. So Leena, if I give up the green card but remain as a U.S. tax resident on visa, when will that 8-year rule stop?
Yes, so that's a great question because the 8-year rule stops as soon as you gave up your green card. And also it applies. So let's say if you were residing in the United States, but you were not a green card holder, that time you spent in the United States before getting a green card would not be counted towards the 8-year test. So the 8-year test only applies from the period you acquired the green card to the period you abandoned the green card officially. Warren, do you have any thoughts on that?
Yeah, abandoning it doesn't mean throwing it in the garbage can.
No, it's just officially giving it to at the port of entry by obtaining that form I-407, and there are other ways to abandon as well.
Yep.
Thank you, Leena. Warren, we also have a question on would a green card holder living in Canada as a Canadian tax resident avoid the period living in Canada to be added to that 8-year limit?
As long as they haven't formally abandoned their green card, they are subject to the exit tax and either formally abandoned or having it judicially rescinded. So they're really stuck in a corner there. There's frankly lots of Canadians who have had U.S. green cards and think that they've expired. And they said, oh, I never renewed it. Remember, it's a lawful permanent resident. That word permanent is important. The only time that green card, not the card may expire, but the status doesn't expire, is if you move outside the United States, but you still have the status until it's identified by a U.S. immigration official. Now, if you cross the border, if you've been living in Canada for 10 years and you cross the border with a green card and say, I've got a green card, or they identify you as a green card in their computer systems, and if you hand them the green card, they'll probably snip it in half for there. The danger here, especially in this U.S. exit tax environment, if you haven't solved this problem, you now are a covered expatriate and are subject to U.S. tax, potentially U.S. exit tax, and have all these filing obligations. And remember, the filing obligations impose penalties even if you don't owe tax. In other words, you could be penalized for failing to disclose financial accounts outside the United States, failing to disclose an ownership interest in a Canadian corporation, in a Canadian partnership, in lots of different things. So, the last thing you want to do is be a green card holder that hasn't formally abandoned it, and you're living outside the United States, and it could be pulled on you at any point in time. Either don't enter the U.S., because I know of no situation actually where U.S. immigration officials have gone across the border to Canada or any other country to rescind it, or you got to deal with your status as potentially as a covered expatriate.
And Warren, just one quick comment on that as well. So it's probably better that the person abandoned it themselves than all of a sudden, if they're entering the United States and them taking it away from you. So at that point, you would be renouncing and abandoning the green card officially.
Yeah, you always want to be in control, and that green card holder. Yeah, this is where it's on you if you're a green card holder to take actions to protect yourself. Because if you cross the border for a Seahawks game, that could be the most expensive game you ever went to.
Thank you, Warren. Yeah. Okay, so I guess we'll just take a last question as the timing is about 10 right now. Leena, this is related to the net worth. If I have a joint account with my spouse who is not a U.S. person, should I report this account or 50% of the value as the net worth?
So this is a tricky question, and also it depends on who the actual contributor is. So let's say if I own an account with my spouse and I am the contributor, which comes from my wages, and I put that money in the bank account, even though my spouse's name might be on that bank account, but that doesn't mean that he is the legal owner of that account. So in theory, I would have, if that's the U.S. person has is the contributor, they would have to report the 100% value of that account on the Form 8854.
Yeah, that's an interesting point, actually, and often misunderstood by people. And oftentimes seniors will have one of their children on a joint account with them. Now, from the bank's perspective, it means that their child, and I say child, I mean they're an adult child, it can undertake all the actions. They can withdraw the money from the account, they can deposit money in the account, they can transfer money from the account, even though they're not the actual legal owner, they're the owner on title, but it remains the property of the person who essentially deposited the money, whose money it was that was deposited into that account. Now, we talked about earlier about community property. If you're in a community property state, have a joint account, you say, well, this is all was my spouse's income that went into that account. If you're in a community property state, half of it is yours, even though the spouse earned 100% of it. When people move from the U.S. to Canada, we want to make sure we kind of separate those, because in that income splitting world, we want income going to that lower income spouse potentially. And when you're coming from community property state, there's a real good tax planning opportunity there. Hey, well, thank you very much for your time. It's 10:01 here in BC and 11:01 in Calgary. We appreciate having you come here with us. Thanks for being with us. Leena, thanks for presenting with me.
Thank you,
that was fun. So excellent. Have a great day.